Welcome back to the Deep Dive. Today, we are jumping straight into, well, what has to be the fastest moving, highest signal environment in all of biotech finance.
It really is. The velocity is just incredible right now.
Absolutely. We have been handed all the previews, the strategy guides, the tactical playbooks for the 44th annual JP Morgan Healthcare Conference, JPM.
Which officially starts next Monday, January 12th. But that's not the real story, is it?
Exactly. Our mission today is to cut through that noise, extract the actionable insights from this high-velocity world. Because look, if you focus on the glossy conference presentations, you're already late.
You're way behind. The real story, the one that institutions are trading right now, is what's happening this week.
So this is what you call the shadow week.
Precisely. Today, January 5th, is the start of it. It runs through the 11th, and I can't stress this enough. Institutional alpha is overwhelmingly generated here.
Not during the actual conference.
Not during the keynotes. In 7 days before the conference even begins.
So why? Why are companies strategically dropping huge announcements this week before Monday?
It's all about narrative control and volume.
Okay, what do you mean by volume?
Think about it. If you drop a press release Tuesday morning this week, you own the news cycle. You get dedicated media attention.
Whereas next week,
your news is competing with 50 other simultaneous updates. Plus, a press release avoids a live Q&A where analysts can, aggressively poke holes in your story.
you control the message completely.
100%.
So let's talk about the tactical framework.
Yeah.
The data behind this shadow week phenomenon is pretty stark.
It's undeniable. When you look at the historical pattern analysis for JPM, something like 60 to 70% of the stock moves happen this week, January 5th to the 11th.
Which leaves only 30–40% for the actual conference itself?
Right. So the market has already priced everything in before the CEOs even step up to the podium.
That's an incredible statistic. It means if you're waiting for Monday's kickoff, you've missed the boat.
You've missed the majority of the move. And the institutional playbook is built entirely on that asymmetry.
Okay, so let's unpack that playbook. The strategy we're seeing is very explicit about timing.
It is. It says accumulate your high conviction plays early in the week, so January 5th through the 8th.
And then?
Then, if those catalysts actually happen, if the M&A rumor becomes real, you have to be disciplined. You trim 30 to 50% of the position around Tuesday or Wednesday of the conference week.
January 13th or 14th. Why is that trimming so critical? What happens if you get greedy?
It's the classic buy the rumor, sell the news. The market often takes profits midweek during the conference because, well, the easy money was made in shadow week.
And if you hold on, you risk giving back all those gains.
You give it all back. The trimming locks in the premium the market paid you for the possibility of the deal.
Okay, so when should we expect the big news to drop?
The peak leak window, historically, is Tuesday through Wednesday of this week, January 6th and 7th. That's the 48-hour period to watch for a big M&A deal or some surprise data.
What's fascinating is the sentiment going in. The Biomed Nexus reader poll shows, well, a huge amount of optimism.
It does. 39% are predicting record M&A. We're talking $10 billion plus deals.
And only 27% expect a quiet conference. So, what, 2/3 of the readers are bullish?
Which, for a contrarian, raises a big red flag.
Yeah.
When everyone enters JPM feeling this good, it usually sets up for a sell the news fade.
Unless
a truly transformative mega deal lands on Monday morning, January 12th, to completely reset the narrative.
So let's check the pulse then. The main market barometer is the XBI, the Biotech ETF. How is it reflecting this tension?
The XBI is pushing toward $108 right now as desks get positioned, but the real signal, the line in the sand, is a clean break above $110.
And it has to be on heavy volume, right?
Crucially, it needs to be on 2x average volume, over 25 million shares.
Right.
That confirms the blue sky breakout is real for Q1. If it drifts up to $110 on thin volume, I'd trust the fade.
All right, let's get into the major drivers, the immediate catalyst. We're already seeing Gilead Sciences, GILD, trading up pre-market.
Yeah, on rumors of a mid-cap oncology acquisition.
And the specific flavor of the month seems to be T-cell engagers. Why are those so hot right now for a buyer like Gilead?
This is where the science is really driving the M&A value. T-cell engagers are their next-gen bispecific antibodies.
Meaning they do two things at once.
Exactly. They're like molecular double-sided tape. One side grabs onto the tumor cell, and the other side grabs a CD3 protein on your own T-cell.
So it physically drags your immune cell right up to the cancer cell.
And forces it to attack. It basically turns your own immune system into a guided missile. And the efficacy is just stellar 60 to 80% response rates in some really tough blood cancers.
And we know the rumored targets.
We do. Merus, MRUS, is up 4.5% pre-market on its colorectal cancer asset. And Cullinan Oncology, CGM, is seeing just a ton of call buying activity.
So what's Gilead's strategic rationale here?
It's simple, but it's urgent. They have a huge oncology pipeline gap to fill. Their last big buy, Trodelvy, has been a bit of an underperformer.
Right, it's doing maybe $1 billion in sales versus the 2 to 3 billion people were expecting.
So they have capital, and they need a high-quality, late-stage asset. A $3 to $5 billion premium for a differentiated T-cell engager is, frankly, easily justified for them.
Okay, that's the immediate M&A catalyst. Let's shift to the second massive macro driver, which is the Biosecure Act and this geopolitical shuffle.
This is the big one. It's a foundational, decade-long shift. We just saw Lonza Group announce a huge CapEx investment, $500 million to $1 billion, to expand their facility in Portsmouth, New Hampshire.
And they were explicit about why.
Completely explicit. They cited unprecedented demand from U.S. biopharma clients exiting Chinese CDMO contracts. They're talking about companies like WuXi AppTec.
And the market reaction tells the story. WuXi shares dropped 4% overnight.
Because the market sees this as a permanent loss of revenue, not a temporary blip.
So the thesis here is that this decoupling creates a long-term manufacturing scarcity in the West.
Exactly. And that scarcity gives Western players like Lonza and Samsung Biologics huge pricing power. We're talking 10-20% price increases, maybe 15-25% revenue growth for years.
But scarcity always has a flip side. What does this do to the small biotechs who rely on WuXi?
It's a huge problem for them. They're facing, first, an urgent need to transfer their tech, which is not easy, and second, a projected 30 to 50% increase in their cost of goods sold, their COGS.
A 30 to 50% cost increase is staggering. That doesn't just hurt profits, that fundamentally changes your entire R&D budget.
It does. For a cash-strapped biotech with a promising phase 2 drug, a 50% COGS hike is potentially ruinous. It creates this bifurcated market.
Where the big guys get bigger and the small guys.
The small guys are forced to sell. It just accelerates the M&A pressure, but only for the ones who can act fast and secure that U.S.-based capacity. It's a massive driver of urgency this week.
Okay, so let's distill this down into some high-conviction tactical plays.
Yeah.
If you had to look at the pro-buy list from our sources, who are the top 5 positioned for this shadow week?
Let's start with the 2 core M&A plays. And the recommendation here is for a disciplined 5 to 7% position size.
Okay, who's first?
First up is Cytokinetics, CYTK. They are, without a doubt, the belle of the ball right now after getting Mycorrhiza approved back in December.
And the M&A speculation is just off the charts.
Massive. You have potential buyers like AstraZeneca, BMS, anyone looking for a leading cardiovascular franchise. This would be a big deal, a plausible $15 to $20 billion takeout.
Which would be what, $150, $200 a share?
In that ballpark, yeah.
All right, M&A target number 2.
Legend Biotech, LEGN. They have what is arguably the best-in-class CAR-T moat with their drug Carvykti.
It's a smaller, more digestible target.
Exactly. An $8 to $10 billion market cap makes them a perfect bite-sized, high-quality target for a big pharma player like Pfizer or Merck who wants to get into the CAR-T game instantly.
Okay, moving from M&A to growth. Ascendis Pharma, ASND, is on the list as an undervalued growth story.
That's right. Their once-weekly growth hormone, Skytrofa, is just crushing it. It's gaining market share fast, and we expect their 2026 guidance will be strong, probably in the $500 to $700 million range.
Which supports that $180, $200 price target.
It does.
And for the safe bet, the large cap anchor.
It has to be Gilead, GILD. You get great downside protection from that 3.8% dividend yield, plus all the M&A upside we just talked about. If they announce a deal this week, that stock moves to $9,505 pretty quickly.
Let's get to the last one. This is the highest conviction, most binary play on the list. Viking Therapeutics, VKTX. It has an impact score of 9.8 out of 10.
This one is truly asymmetric. The catalyst is the design reveal for their phase 3 oral obesity trial. That's on January 14th.
So it's a pure play on the massive obesity market.
Pure play. If the trial design is credible, meaning it's powered to show 15 to 20% weight loss, the stock could double to $140 on M&A speculation alone.
I have to push back on that a bit. An impact score of 9.8 suggests a lot of conviction, but you're also saying it could get cut in half down to $30 or $40 if the design underwhelms. How is that a conviction buy?
It's a fair question. The conviction isn't in the safety of the trade. It's in the size of the potential win. The reward is so heavily skewed to the upside because the market is absolutely desperate for another major player in obesity. If the design details are strong, the risk of a drop is almost immediately offset by takeover interest. That's why it's the highest potential return play of the week.
Beyond the company's specific plays, there's another really critical event happening this shadow week, the Atara Biotherapeutics ATRA PDUFA date.
Yes, that's for Saturday, January 10th. And an approval for their drug, Tab-cel, would be a monumental precedent for the entire cell therapy field.
Why is this so important?
Because it would be the first ever FDA green light for an allogeneic or off-the-shelf T-cell therapy.
Okay, let's pause on off-the-shelf. This is the holy grail for Curity, right?
Yeah.
It changes the entire economic model.
It changes everything. The current model, autologous IRT, is individualized. You take a patient's cells, ship them, manufacture the therapy, ship them back. It's slow, and it's incredibly expensive.
$400,000, $500,000 a dose.
Right. An allogeneic approval validates a new model. You mass produce the therapy from a healthy donor, it's faster, and it could bring the cost down to maybe $100,000, $200,000.
So an approval for Atara would just accelerate the entire allogeneic pipeline.
Instantly. It would be a huge tailwind for companies like Allogene, Fate, Caribou, because it proves the manufacturing model actually works at a commercial scale.
Okay, switching gears quickly, we also have this Sell the News test with Vanda Pharmaceuticals.
VNDA, yeah. It's up 22% after getting its motion sickness drug approved. The question is this a short squeeze that takes it to $8, $10, or is it a rational fade back to $5?
You have to watch the volume.
You have to watch the volume. But if you want to know where the real deals are getting made this week, away from the charts, you have to look at the shadow calendar.
The unofficial events in San Francisco. Give us the insider view.
The most important conversations are happening in hotel lobbies and private receptions. Two events in particular are major signal generators.
Okay.
First, Monday at 4:00 p.m. is the Stat News reception. This is where CEOs informally leak strategic updates to top journalists. You absolutely have to be watching Stat News on Monday evening for stories that will drive Tuesday's trading.
And the second one.
Wednesday, 9:00 p.m., the Leerink After Hours event. This is the private party where M&A deals often solidify. If you see unusual volume or price action in a stock, late Wednesday.
It's a signal that a deal might be coming later in the month.
It's a very strong signal, yes.
Yeah.
And it informs that trimming strategy we talked about.
Okay, so let's bring it all together. What is the core tactical takeaway for someone trying to navigate JPM 2026?
I'd say success this year relies less on what you hear during the official presentations and more on your discipline this week. It comes down to two things. One, disciplined position sizing. That 5 to 7% for those core M&A plays like Legend and Cytokinetics. And two, and this is critical, the strategic trimming of profits, 30 to 50% on January 13th or 14th if those shadow week rumors actually come true.
So this JPM is really defined by two massive colliding forces. You have the immediate, $15 billion plus M&A potential heating up right now. And then this long-term structural shift from the Biosecure Act.
A shift that's forcing the entire industry to prioritize supply chain security over pure cost savings.
It really feels like a paradigm shift.
It is. And we focus a lot on the immediate stock prices, but let me leave you with a final thought to consider for the long term. The Lonza expansion, it confirms this deep move towards security at all costs. We might be seeing the end of the growth at all costs era in biotech.
But what does that mean practically?
Well, think about it. If the cost of manufacturing jumps by 30 to 50% for every small biotech transitioning from LuBE, how does that reshape the industry over the next decade? Does innovation start to suffer? Do we shift back to only funding massive blockbuster drugs because the higher costs demand billion-dollar revenue streams?
That's a huge question, one with implications that will last long after JPM is over. But for now, you're armed with the tactical playbook for this critical shadow week. You have a huge shortcut to the week's most important catalysts. We'll talk to you next time on The Deep Dive.